The financial landscape is abuzz with remarks from Jamie Dimon, CEO of J.P. Morgan, who has issued stark warnings about the future of the bond market and the geopolitical shifts affecting global economic dominance. Dimon predicts an inevitable crack in the bond market due to excessive fiscal and monetary policies. He also highlighted the shifting geopolitical tectonic plates, suggesting that the U.S. could lose its status as the issuer of the world's reserve currency within 40 years if it doesn't maintain its economic and military supremacy. This comes amid concerns about the U.S. potentially inflating its way out of debt or resorting to financial repression, as discussed by Scott Bessent in a congressional hearing. In parallel, geopolitical tensions are impacting markets, particularly with developments in the Middle East and Asia. The U.S. has proposed a nuclear deal to Iran, which involves relinquishing its nuclear enrichment capabilities, a move that could alter the regional power dynamics, especially with Saudi Arabia's involvement. Meanwhile, U.S. sanctions on Iranian oil are being paused, potentially benefiting China's energy needs and influencing crude oil prices, despite OPEC+'s agreement to increase production. Additionally, in Asia, U.S. Defense Secretary Pete Hegseth's comments on China's military ambitions have stirred regional tensions, particularly concerning Taiwan. This geopolitical backdrop, combined with trade tensions, including increased tariffs on steel and aluminum by President Trump, underscores the intricate link between geopolitical maneuvering and financial markets, influencing global trade, investment strategies, and economic policies.
Tensions are escalating between the United States and China over a trade dispute concerning critical minerals, as U.S. President Donald Trump and Chinese President Xi Jinping are expected to discuss the issue soon. The dispute centers on allegations by Trump that China has violated an agreement to roll back tariffs and trade restrictions on essential minerals, crucial for global industrial supply chains. U.S. Treasury Secretary Scott Bessent expressed confidence that the upcoming dialogue between Trump and Xi would resolve the matter, despite China's Commerce Ministry rejecting the accusations as groundless and vowing to take strong measures to protect its interests. The disagreement comes in the wake of last month's Geneva Agreement, where both nations agreed to pause certain tariffs for 90 days, and China committed to lifting restrictions on critical metal exports necessary for U.S. industries like semiconductors and defense. However, the U.S. has introduced new measures, including AI chip export controls and increased tariffs on steel and aluminum imports, further straining relations. The outcome of the anticipated conversation between Trump and Xi could significantly impact global markets, particularly in sectors reliant on these critical minerals, and may influence future trade negotiations and economic policies between the two economic powerhouses.
Iovance Biotherapeutics, Inc., is currently embroiled in a class action lawsuit initiated by Pomerantz LLP, which accuses the company and certain officers or directors of securities fraud and other unlawful business practices. This legal action was prompted by Iovance's disappointing first quarter 2025 financial results, which showed a significant drop in total product revenue from $73.7 million to $49.3 million. The company also sharply revised its full-year 2025 revenue guidance downwards, from $450 to $475 million to $250 to $300 million. This adjustment was attributed to challenges related to the launch of Amtagva, Iovance's lead product candidate, and issues with the growth trajectories and treatment timelines for new authorized treatment centers. The market reacted negatively to these developments, with Iovance's stock price plummeting nearly 45% to close at $1.75 per share on May 9, 2025. This decline reflects investor concerns over the company's future revenue prospects and the potential implications of the lawsuit. The class action lawsuit invites affected investors to join by July 14, 2025, and its outcome could significantly impact Iovance's operational strategy and market position, particularly if the allegations are proven true. As the situation evolves, stakeholders will be closely watching for Iovance's strategic responses and any further legal developments.
The Reserve Bank of India, RBI, is poised for a 25 basis points cut in the benchmark repo rate, reducing it to 5.75% as its Monetary Policy Committee concludes its meeting. This marks the third consecutive rate cut in 2025, reflecting the RBI's accommodative stance Amid a slowing economy and global uncertainties, India's GDP growth has decelerated, with Q2 FY25 growth at 5.4% and a full fiscal year growth of 6.5%, prompting calls for monetary easing to boost domestic demand. Global factors, including the threat of renewed U.S. tariffs and a weakening Chinese yuan, have added complexity, pressuring the Indian rupee, which has depreciated by over 2% this year. The RBI is expected to employ liquidity tools like open market operations and forex management to stabilize the currency. The easing inflationary environment, with CPI inflation at a multi-year low of 3.16% in April 2025, provides the RBI with the policy space to prioritize growth. Economists largely support the rate cut, with forecasts of further cuts in the coming months. The rate cut is anticipated to lower borrowing costs, stimulate credit growth, and boost investment and demand, benefiting equity markets, particularly in credit and consumption-sensitive sectors. However, the impact on the Indian rupee and fixed income returns for conservative investors will be closely monitored. The RBI's future guidance, especially regarding global trade risks and liquidity measures, will be crucial for market sentiment and the Indian economy's trajectory.
Faruqi & Faruqi, LLP, a prominent securities law firm, has announced an investigation into potential claims against Iovance, Inc., following allegations of securities law violations. The firm is focusing on Iovance's failure to disclose the at-will nature of its contract with the Kroger Company, a major client. This lack of transparency is alleged to have misled investors about the risks associated with Iovance's financial stability and client relationships. The investigation pertains to Iovance's initial public offering (IPO) on April 18, 2024, and subsequent stock performance, which has seen significant declines due to financial underperformance and unmet earnings expectations. Following its IPO, Iovance reported a net loss of $34 million for Q2 2024, driven by a sharp increase in operating expenses. The company's third-quarter revenue forecast also fell short of market expectations, leading to a 26% drop in stock value. Further compounding investor concerns, Iovance's Q4 earnings for 2024 missed estimates, prompting a 46% plunge in its stock price after disappointing Q1 2025 guidance. This series of financial setbacks has catalyzed the class action lawsuit, with Faruqi & Faruqi encouraging affected investors to seek lead plaintiff status by the June 16, 2025 deadline. The outcome of this litigation could have significant implications for Iovance's financial health and investor confidence.
Apple Inc., AAPL, is facing a mix of short-term challenges and long-term growth opportunities, according to a recent analysis by Bank of America analyst Wamsi Mohan. The report highlights potential headwinds such as regulatory pressures, U.S.-China trade tensions, and Apple's position in the artificial intelligence (AI) market. Concerns are raised about Apple's reliance on its supply chain in China, which could be affected by tariffs, and the potential for AI advancements by competitors like Alphabet Inc., Google, to draw users away from Apple's ecosystem. Additionally, there's skepticism about Apple's growth prospects beyond the iPhone, with questions about the company's ability to introduce a new groundbreaking product. Despite these challenges, Mohan maintains a buy rating for Apple, citing the company's strong financial performance, robust installed user base, and potential for significant product upgrades, such as an ultra-thin iPhone in 2025 and a foldable model by 2026. The analyst emphasizes Apple's ability to consistently exceed earnings expectations and expand margins, supported by its vertical integration and services growth. Although Apple trades at a premium valuation, Mohan argues that this is justified by the company's business quality and low interest rate environment. Currently, Apple stock is priced at $200.99, showing a 17.5% decline year-to-date in 2025, within a 52-week range of $169.21 to $260.09.
Digimarc Corporation is currently embroiled in a class action lawsuit filed by Pomerantz LLP, a law firm specializing in corporate and securities litigation. The lawsuit alleges securities fraud and other unlawful business practices by Digimarc and certain officers. This legal action follows the company's disappointing financial results for the fourth quarter and full year of 2024, which showed a 10% decline in subscription revenue and a drop in annual recurring revenue from $22.3 million to $20 million. These declines were attributed to the expiration of a significant commercial contract in mid-2024. As a consequence of these financial disclosures, Digimarc's stock price plummeted by 43.1%, closing at $15.39 per share on February 27, 2025. This sharp decline reflects a loss of investor confidence and highlights potential vulnerabilities in the company's business model, governance practices, and transparency. The class action lawsuit offers investors an opportunity to seek redress for their financial losses, with a deadline of July 7, 2025, to request the court to appoint them as lead plaintiff. The situation underscores the critical importance of transparency and robust contract management in maintaining investor trust and market stability. The outcomes of the legal proceedings could have far-reaching implications for Digimarc's market valuation, financial health, and its ability to attract and retain investor support.
The main financial event discussed is the potential stock market recovery, highlighted by a temporary de-escalation of U.S. tariffs, which has led to strength in major indexes like the S&P 500 and FTSE 100. This recovery presents a buying opportunity for investors, particularly in two beaten-down stocks, Amazon and Melrose Industries. The article emphasizes the importance of not missing out on the rally despite ongoing risks such as persistent inflation, geopolitical tensions, and fragile tariff truces. Amazon, AMZN, is spotlighted as a promising investment due to its significant market position and growth potential, particularly in its cloud computing division, Amazon Web Services, AWS. AWS, which commands nearly a third of the cloud services market, is benefiting from increased AI adoption. The development of in-house chips like Trainium 2 and the upcoming Trainium 3 enhances AWS's margins and reduces reliance on external suppliers like NVIDIA. However, Amazon faces challenges in its core e-commerce business due to tariffs, despite a temporary reprieve. Its high forward PE ratio of 31.1 suggests that the market has priced in its growth potential, but it also leaves little room for error. Melrose Industries, MROL, an aerospace and defense company, is another stock to consider. Despite a 26% decline in share price over the past year, the company faces supply chain challenges, but its financial performance remains strong, with a 42% profit increase and an 11% revenue rise last year. As military budgets increase, particularly in the UK and NATO, Melrose's defense division is poised for growth. The company aims for £5 billion in revenue by 2029, and with a forward PE below 14, it presents a potentially lucrative opportunity for investors.
Greece is embroiled in a major financial scandal as the European Union demands the repayment of €670 million in mismanaged farm subsidies. This demand follows revelations of systemic failures in Greece's subsidy distribution, with funds being allocated to non-existent farms and improperly documented land. The scandal, which spans over a decade, highlights significant oversight lapses within the Greek Agricultural Payments Organization, OPEKEPE, which has since been disbanded by Athens in response to the EU's call for reform. The misuse of funds was facilitated by outdated mechanisms and insufficient cross-checking, leading to unchecked corruption that persisted across multiple governments. The implications of this scandal are profound, not only for Greece but for the EU's broader agricultural policy. The Greek government is now faced with the challenge of repaying the substantial sum using public funds, placing the financial burden on taxpayers rather than those directly responsible for the fraud. This situation raises concerns about the effectiveness of oversight and accountability within EU subsidy programs. Additionally, Greece is likely to encounter increased scrutiny on future applications for the Common Agricultural Policy, CAP, potentially affecting legitimate farmers who rely on these funds. The incident underscores the necessity for robust reform to prevent such mismanagement and restore trust in EU financial mechanisms.
Tom Lee, managing partner and head of research at Fundstrat Global Advisors, has projected a bullish long-term outlook for Bitcoin, estimating its value could reach up to $3 million per coin. Speaking with CNBC, Lee suggested that Bitcoin could realistically climb to $250,000 by the end of 2025, Driven by global adoption trends and a limited supply, he highlighted the significant demand-supply imbalance, noting that while 95% of Bitcoin has already been mined, the majority of the global population has yet to own any, indicating substantial potential for increased demand. Lee's predictions are underpinned by the belief that Bitcoin could eventually surpass the market value of gold, which currently stands at approximately $23 trillion. If Bitcoin were to achieve parity with gold, its price could rise to about $1.2 million per coin. However, Lee argues that Bitcoin's superior properties could propel its value to between $2 million and $3 million in the long term. This outlook resonates with a growing sentiment among institutional investors who view Bitcoin's scarcity and decentralized nature as valuable hedges against inflationary pressures in the global economy.